Thanks, Cynthia. I want to just also thank Austin and Taylor and the entire Integrated Equities team for putting on this presentation. Um, we really appreciate Integrated Equities giving sponsors like ourselves the opportunity to kind of discuss our platform. I also want to thank all of you for coming out here today. I mean, if I were you, I'd be out golfing. But anyways, let's move on and we'll get going. Let me just have a brief overview of what we're going to talk about today. Here we go. Again, my name is Scott Lee. I'm one of the founders of Revesco, and I'm here to talk about our fund, Revesco Properties Trust, as well as investing in U.S. commercial real estate, and in particular, retail shopping centers. So, who's Revesco? Well, at Revesco, we're not just experienced, we're seasoned. No, this is not an ad for Grecian Formula or Rogaine. This is actually all of us. Yes, we do have over 100 years of experience in real estate. We do know the ins and outs of commercial retail. We have built extremely strong relationships with retailers throughout North America over our careers, and it's allowed us to invest in over $390 million worth of shopping center transactions. Quite honestly, there isn't one national retailer in North America that we don't have access to somehow, some way. As a consequence, our average annual return on our past deals was around 19.5%, with a typical hold period of about 4 years or so. One last point I want to make is while Chris, myself, and my partner Julianne Booker here are located in Vancouver, my entire operational team of over 20 people is actually located in Denver. Now you go, well, why is that? Well, two reasons. One is we want to make sure that we're in the United States as a local buyer of real estate. You don't want to be a sponsor from Vancouver trying to buy US real estate. You will get your head handed to you. Secondly is we located in Denver because it's a hub for United Airlines. United can be in anywhere where our shopping centers are located within a day. And we find that's really important when you're trying to actively manage real estate. We want to be seen as local. Okay, so what do we buy? Well, think about your grocery anchored shopping center or your daily needs based retail center. So we focus on shopping centers like Caulfield Village in West Van, Summit Square in Coquitlam, or say Garden City Shopping Center in Richmond, or for Victoria people, Broadmead Shopping Center in Saanich. That's the type of stuff that we like to focus on. What we don't acquire is we do not acquire enclosed malls. That's not an area that we play in. Here's a couple of things that we like to focus on when we buy an asset. We always like to buy something that's below replacement cost. I want to be cheaper than the guy who builds new to me if he's across the street. Second thing is, this is very near and dear to all your hearts. I like cash flow, and our investors love cash flow too. We got to make sure we have cash flow day one from these acquisitions. The other thing that we try to do is we want to invest in shopping centers that have strong, stable retail tenants that can consistently pay their rent. Like, for example, a Whole Foods, a Winners, a Marshalls, or a HomeSense. Okay, so you might be wondering why open air retail and why in the US? Well, open air retail actually is a pretty exciting place to be. And a little bit of a humble brag, not everybody can do it. The reality is there's something called a knowledge premium when it comes to retail real estate. Let me give you an example. When you're looking at retailers in a specific market and you have deep intel about that trade area, and then you look further and we start looking at specific properties, there's an opportunity here for investors or sponsors to kind of look and see where it's kind of like skating to where the puck is going to be as opposed to where it has been. If it sounds like a little bit like insider trading, well, trust your judgment. It's kind of like that, but we like to call it good research. And we utilize that basically with our experience with our tenants. And that's how we're getting this kind of information to allow us to make investment decisions on our behalf, as well as the investors. While our entire career has kind of been in this retail world, and so we do know this space kind of better than most. Many of you are probably sitting there going, well, hey, what about e-commerce? Is that not going to annihilate the retail world? Well, a couple of things. First of all, COVID kind of took care of that. What I mean by that is it kind of culled the herd of all the weak retailers. So what's left are usually the strongest and best retailers in the world. Still over 80% of our US customers prefer to buy groceries in physical stores. So that makes grocery anchored shopping centers extremely resilient. Also want you to think about what's happened in the commercial real estate world over the last, call it 10 years or so. Investors have poured billions and billions of dollars into kind of three genres of commercial real estate: residential, industrial, and pre-COVID office. So the one area that's completely been underfunded for years is retail real estate. So as a consequence, what's happened is there's a huge lack of supply of new retail space coming on board. So the result is for Revesco and our investors is some of the best tailwinds we've seen. The retail vacancy rate in the United States right now has never been lower in my entire career. And I've been doing this a long, long time. In terms of rental rate growth, I've never seen it rise so quickly so much over the last few years. And it's projected to continue to do that because it takes so damn long to get new product on the market. Ask yourself, for example, try getting a plumber or electrician or a contractor to come to your house and fix something. That's the exact same issue we have throughout the United States as it comes to trying to build new retail. Quite honestly, they just can't afford to do it. I was on the phone Friday with RioCan REIT, the chief investment officer. He said the same thing. He said in Canada, they're having the same issue as well. They cannot build new. And that's why you're seeing vacancy rates so low and rising rental rates and rental rate growth. Here's just an example of a shopping center that we own half of it, and we're about to acquire the second half. I want to talk about a little bit more, but just to give you kind of a visual feel for some of the things that we invest in. So why do we invest in the US and not in Canada? Well, our investors and myself love cash flow. And the cash on cash returns in Canada are just so incredibly low. And you wonder, well, why is that? Well, if you look at where the Canadian pension funds, the REITs, and most of the wealth funds have invested, they bought most of the retail shopping centers in Canada. And so everything is absolutely priced to perfection. So when we look at things in the United States, look, our fund usually kicks out about a cash distribution of about 6%. And our average annual return is somewhere between 12 and 15. So that's just something to keep in mind as you're looking at kind of the differences between, say, the US and Canada. The other thing to keep in mind too is the US is 10 times larger than Canada. You know, essentially, Canada is the size of California. Right? So we have the opportunity to kind of look at all sorts of different assets. Now, we don't just buy anywhere. You know, we're focused on kind of these fundamentals. We want strong population growth. We want high incomes. We want a highly educated population. We want markets to have a low vacancy rate with really, really high barriers to entry. But, you know, most importantly, what we try to do is listen to our tenants, because our tenants will tell us where they're having difficulty finding new growth opportunities or new real estate opportunities. And that's where we like to invest as we move forward. Let me just give you two quick examples of what we would do and not do. Austin, Texas. It's a phenomenal market. It's got high population growth, really well-educated folks. It's the home of Whole Foods and Dell Computers. But quite honestly, from our perspective, it's just too expensive to make any money off of for our investors. So we looked at another market nearby in Atlanta. It's 6.5 million people. It's home to some of the biggest corporations in the world. It's got the world's busiest airport, which I did not know. And most importantly, one of my good friends, a guy named Naveen Jaggi. Now, this guy is the head of global retail for JLL. And I was with him last week, and he told me that Atlanta is one of those markets where most of his clients can't find enough real estate. So that to me is like, that sounds interesting. Let's look at that. So those are some of the things that we would do. What really sets Revesco apart is kind of our strategy and what we do in terms of managing our properties. Each one of these properties is something unique. We have a business plan for each and single one of them. We don't just set a property and then forget it. We're constantly looking at the property for strategic improvements and creating additional value through these four elements. You know, leasing up vacant space, restructuring leases, improving the tenant mix, and adding retail density where we can. So look, at the end of the day, my role as a sponsor is to provide consistent, stable income, as well as creating wealth generation, wealth creation for our investors. And the way we do that is by executing on these four elements day to day. So now when you're talking about real estate, you can't talk about real estate without talking about your debt strategy. This is how so many sponsors have ended up upside down recently. Our debt strategy is very Canadian. In other words, it's very conservative. We usually use about a 50% loan to value ratio, which is very low in the commercial world. And that's something that we are very comfortable with, because quite honestly, that's where most of our money is. So in doing so, we also make sure that we use no variable rate debt. Everything's fixed. We have about a debt strategy of making sure that no more than 15% of our mortgages roll in any given year. So when the markets get a little rocky, we're in a strong position, kind of weather that storm, if you will. Right? So really, at the end of the day, what ties all of this together is our deep relationships and knowledge within the retail world. For example, Austin, for example, he could call Nordstrom Rack's real estate department every day for a year, and he will never get a phone call back. I was with John Dolson, a senior VP of real estate for Nordstrom last month, talking about all things in the United States. Now, that's the kind of access that we have with our tenants. And that's some of the things we bring forward to our investors to kind of hedge the risk, if you will, and create what we hope is outsized returns for all of us in that regard. Okay, so at the end of the day, the result of this approach is kind of a series of successful exits over the past several years. Roughly speaking, kind of average about 19.5%. The last few years, around a 4.5-year hold. I just want to talk briefly about a couple of examples of what we would do at different points in time in the market cycle. So I don't know if any of you have been to Montana or know Bozeman, but this is where the show Yellowstone is filmed. I didn't know much about Bozeman, Montana pre-COVID, but it is an incredible little market. There's also a very wealthy market. This shopping center here we bought pre-COVID, and we couldn't quite get our head around to it, but it was because there were some tenants that were uncertain. There was about 10,000 square feet of vacancy that scared off a lot of buyers. But once we saw that it was anchored by Target on one end, and in the other end of the shopping center, it was anchored by Costco, we immediately knew that we could get the best intel over anyone, because in my past career, I represented both Costco and Target. I brought Target in, I brought Target out. It's one of those things where we still have those relationships. They told us that their sales are just off the charts and told us how strong this market is. So we jumped in and acquired this asset. We restructured a few leases, leased up the vacant space, and then lo and behold, the buyer came along that really wanted to have this asset, and we were able to exit out of it in a very short time frame, creating a 28.5% return for our investors in that particular asset. Here's a totally different type of strategy. This is a grocery anchored shopping center in Texas, great area, but we kind of knew that Randall's may or may not stay. It's a division of Safeway. They were up and down. But oddly enough, in this situation here, we actually got paid twice. Randall's came to us in about the third year of the deal and said, look, we want to buy ourselves out of this lease. So they paid us $2 million to get out. At the same time, we knew that they were weak. We had a Mexican grocery store that was interested, but they wanted to buy the whole shopping center vacant. So we figured, perfect. So we sold the shopping center to them, got paid twice, which allowed us to yield return of about 14% to our investors on that asset. Finally, Shops at Castle Rock. This is kind of straight over the middle for Revesco. A series of large format retailers. We restructured some leases, able to do some lease up. At the end of the day, we were able to turn this asset around very quickly, yielding a 30% return to our investors on this particular transaction. So that's kind of how we do it. So what's next for Revesco? Well, our game plan is to increase the assets under management for Revesco over the next 7 to 10 years to over $1 billion. We feel at that size and scale, we can offer our investors a lot of different options in terms of both income and growth. But what we're really interested in is This year, we have about $52 million of acquisitions that we're actually going to be closing later this month. I'm going to talk about a couple of these transactions. It's going to set us on the course for 25 as well. So I talked about Atlanta earlier. Again, home to 6.5 million people, high growth, great barriers to entry, but most importantly, our tenants are telling us, hey, this is a market we can't get enough space in. This is the shopping center that's located actually just north of Buckhead, which is an exceptionally wealthy area with a lot of high growth. We like the shopping center kind of really for three reasons. One is we're buying it well below replacement cost. Secondly, there's exceptional cash flow to the fund for this asset. It kicks out about 8%. And finally, it's anchored by industry leaders. So Marshalls, Ross, Dollar General, Starbucks. We also have a local grocer on site that's doing phenomenal. So this really fits Revesco's criteria just perfectly. Finally, here's another asset. So Flagstaff, Arizona, I don't know if many of you maybe actually been there. Flagstaff's 2 hours north of Scottsdale. People love it because in the summertime, it's about 20 degrees cooler than Phoenix. And actually in the wintertime, it actually snows up there. So people go up there and go skiing. We own majority of the shopping center, but for the last 3.5 years, we've been trying to buy the Whole Foods right next door to this shopping center. We finally got the doctor to come around and he's actually going to sell it to us at a number that we can kind of make some sense out of. But this is an example where 1 + 1 actually is going to equal 3. So what ends up happening is that when we acquire Whole Foods under the same corporate entity as the rest of the shopping center that we already own, the institutional lender is going to give us kind of grocery anchored valuation, which for all of us in the room, basically is going to mean about an increase in the net asset value of over $6 to $8 million to the fund. So these are the types of things that we like to kind of pursue. We know how to kind of rework the asset and continue with the growth. Finally, I mean, why invest with Revesco Property Trust? Well, a couple of things. We are very experienced in this industry, and quite honestly, there really isn't anything we haven't seen before. So as a consequence, there's alignment. I mean, our money is right beside our investors. We're over 10% of the equity in the fund. While I love upside, I run my business to protect against the downside. So I don't use any variable rate debt. We have a very solid long-term debt strategy. And finally, we use our knowledge and our relationships to reduce the risk and increase the returns for our investors, which kind of, for the end of the day, our fund will yield somewhere around a 6% cash on cash distribution, and our annual targeted growth is around 12 to 15%. My name's Scott Lee, and that's Revesco Properties. Thank you.